And we are live and we are back. Let's go. I'm Cory, your host, one half of the Cory and Pull Up Ad podcast. And I'm back like I never left with another installment of Money Mindset here on the Cory and Pull Up Ad podcast. We discuss health and wealth, finance and fitness, and everything in between. We want to make sure you save more and save less and keep making better your best. Yes. However, when my coach Jordan went on paternity leave, we started these Money Mindsets so we get straight to the financial information, no filler in between. And I know y'all see the topic of today's video. It finally happened, y'all. We only been waiting till like 2020. The Fed finally cut them interest rates. People been waiting for them interest rates been cut. People been waiting for them interest rates to be getting cut. That's what I was about to say. People have been waiting since, I believe, since 2020. But we don't get into the article. We're going to Old Faithful today. Good Faithful, Old Faithful, CNBC, reliable as far as the information today for the Fed interest rate cuts. But people have been waiting for this. Interest rates have already been going, when I say down, I say the interest rate as far as been applying for mortgage, they've been tempering from like that 7%, 6% range. They're down now like the 5.5% range. And we're going to see what this article has, because we don't read articles ahead of time. We're going to see what this article has in store for us as far as what we believe the actual interest rate drop will be. I believe it was 0.5%. Normally it's half a basis point. Normally it's a quarter, 0.25 a basis point. So we are going to see exactly what the CNBC article is talking about the impact will be. All right, but y'all know what to do. Before we get started, make sure y'all comment, like, share, and subscribe. Shout out to the YouTube algorithm. Make sure you leave those rating reviews on the podcast platforms as well. My information, as well as my coach Jordan information, can be found in the description. FinallyFit.live, where you can go to sign up for the 5:30 a.m. Eastern Standard Time, Monday and Wednesday virtual training sessions with Jordan himself. I'll be there too because it's online, but Jordan's the one getting the money, not me. All right. Also, too, y'all, I know when the videos have still been posted, but we ain't been posted a new video. Boy, some stuff then came up, so some stuff going on. So hadn't posted, but this one, we got the recordings and we're posting right now. Monday, Wednesday, and Friday at 7 p.m. as we're still getting into a rhythm of recording consistently, but we were able to, make a decision to drop the recordings as far as the smaller clips in a way we can still at least be consistent with dropping stuff for y'all on Monday, Wednesday, and Friday at 7 p.m. All right. And I know it's late because when I watched the last video talking about the car loan. See, I'm still seeing the car loan at 735 for new and what was that? 534, 525, $734 for a new car payment, and then 525 for a new payment. And I'm seeing 735 here and 523. So still the same numbers here. Student loans. This student loan episode, a couple episodes ago, but almost 2 months ago now. I feel like student loans are what they are. Recommendation: pay them off. Stop worrying about if they're going to get forgiven en masse or not. That's probably not going to happen. Whether or not they say plan or not, gets overturned and deemed illegal. Hey, Biden's not going to be in office anyway because he dropped out of the race. Kamala, Vice President Harris is running against President Trump. So we'll see what happens. And less than 2 months from now, because it's September 19th, less than 2 months from now, we may or may not have. We're going to have a new person that's president because President Biden isn't running anymore. But whether Vice President Harris becomes president or President Trump is back in office, we'll see. All right. Also, too, let me see if I remember how to. Y'all remember I had the hotkeys set up. There we go. Okay, I still got the hotkeys set up. I couldn't remember exactly how I set up. All right. But again, y'all, this is for entertainment purposes only. Myself, George Jordan, fitness professionals, and the cure is for entertainment purposes only. And you need to seek out a professional and do your own research before taking any action. All right. All right, y'all, we're going to get into it. Fed cuts rates. Like I said, I'm going to share the screen real quick. We're going to get to Old Faithful here. Also, too, I believe it was the last episode or one of those recent episodes we had dropped. It didn't seem like my mic was having issues. And all I did was, the traditional, IT troubleshooting way. Unplug it and plug it back in. So hopefully those issues have, subsided, but we'll see. All right, here we go, y'all. Get back in how I want to be. Go this way for now. Let's see how that looks on scroll. Does that mean what the text is going to be? All right, let's get into it. Fed slashes interest rates by 0.5 point. An aggressive start to its first easing campaign in 4 years. Also saw, again, probably in this article, I believe they want the rates to be, when I say the rates that they're cutting here, I think it'll be around 2% or so in the twos. And I think that's in 2026. So we still got roughly 2 years or so until, they're actually down where the Fed wants them to be. The Federal Open Market Committee chose to lower its key overnight borrowing rate by 0.5 percentage point or 50 basis points. So when they say 0.5 percentage point or 50 basis points, so 100 basis point would be 1 percentage point. Amid signs that inflation was moderating and the labor market was weakening. The labor market has been weakening. I don't think they ever actually deemed us to be in a recession. So technically, kind of neither here nor there, slightly related to this, but it is what it is. Also, too, they're probably saying like, hey, let's help things out before. The country is so divided right now, especially when it comes to this upcoming election. But hey, maybe the Fed's trying to do what they can. It was the first interest rate cut since the early days of COVID. This thing, we went through a whole pandemic since the last interest rate cuts, y'all. Just think about how long it's been. The committee has gained greater confidence that inflation is moving substantially towards 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance, the Federal Reserve statement said. Also, too, I'm home by myself. It's the late evening, early evening, after work. So as y'all can see, I got my energy, things like that. So I'm good to go for this episode. Washington, the Federal Reserve on Wednesday enacted its first interest rate cut since the early days of COVID pandemic, slicing 0.5 percentage point off benchmark rates in an effort to head off a slowdown in the labor market. Now, again, they're telling you this is slow down. They did this due to a slowdown in the labor market, not to help y'all asses get out here and get a mortgage. All right, because the labor market is struggling. Y'all might not need to get out here and get a mortgage, okay? Let's put some pieces together now. Anyways, with both the jobs picture and inflation softening, the Central Banking Federal Open Market Committee chose to lower its key overnight borrowing rate by 0.5 percentage point or 50 basis points, affirming market expectations that had recently shifted from an outlook for a cut half the size. Again, I believe the predictions were 0.25 basis point, like I said, so 0.25% or 25 basis points instead of the 50. Outside of the emergency rate reductions during COVID, they were emergency rate reductions, all right. The last time the Federal Open Market Committee, the FOMC, cut by 0.5 point was in 2008 during the global financial crisis. That is insane. So this is, in short, a historic rate cut. This is not just a rate cut. This is a historic rate cut. We're seeing not only the last time that the Fed cut rates was during an historic event, meaning the beginning of COVID. The last time they did it by 50 basis points or 0.5% was during the 2008 global financial crisis. So historic rate cut, not just a rate cut here, historic. The decision lowers the federal funds rate to a range between 4.75 and 5%, while the rate sets short-term borrowing costs for banks. It spills over into multiple consumer products such as mortgages, auto loans, and credit cards. Again, they can cut these rates and they can come back the next time when they're going to announce a decision on an increase or cut or a raise. As far as the rates, they could decide to raise them. This also doesn't mean that banks have to lower their interest rates when it comes to mortgages, auto loans, and credit cards that we see here for the example. This is just what the Fed has done. So in short, the banks are borrowing money from the Fed. They're loaning out to them on a certain interest rate. I believe what they say here. They say exactly what they call it. Oh yeah. Oh, I guess it's to lower its key. It's overnight borrowing rate. So that's what has been lowered between 4.75 and 5%. So in short, that's the money, the banks are paying as far as interest rate they're paying. And, the banks got to, in short, charge you interest so they can make money overall and pay, people they borrow money from back and make money in FSL. In addition to this reduction, the committee indicated through its dot plot the equivalent of 50 more basis points of cuts by the end of the year. So they're talking about doing it again. So again, they're talking about doing two, in short, historic rate cuts, not only within the same year, but back to back. Okay, that's big. Interesting. That's too. That's going to be right around election time, or right after, should I say. The matrix of individual officials' expectations pointed to another 4 percentage point in cuts by the end of 2025 and a 0.5 point in 2026. They're talking about doing a whole 1%. Drastic cuts here, drastic cuts. And again, if we're at 4.75%, to get down to 2% really in less than 2 years, here's about, some point in time in 2026, you got to have some pretty significant cuts here as far as when they actually announce these cuts. And all the dot plot shows the benchmark, shows the benchmark rate coming down about 2 percentage points beyond Wednesday's move. So again, from 5%, as we're seeing, down about 2%. So 2.75 to 3% is what they're talking about here. To commit, and again, that does not mean that's what your interest rate will be for your mortgage, okay, or any loan. That's not what that means. Definitely not for your credit cards. The committee has gained greater confidence that inflation is moving substantially toward 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance, the post-meeting statement said. Here's the one thing with inflation. So inflation, by definition, is stuff going up. So we've already had large inflation, or record inflation, however you want to gauge it. And so the issue is now is yeah, inflation may be, tampering back or going back to that 2 to 4% range, wherever they want to be at, but you've already had that large increase. So, right, so things are just not going up as much. But at the end of the day, that large increase we had in inflation, I believe, would be last year, 2023. Was it 23 or 2022? One of those years. Anyway, inflation doesn't impact me that much, so it's hard for me to remember exactly. But when we had that large interest rate increase, in short, if your income still hasn't caught up to that inflation increase, then you're still going to be behind. Even though it's not going up as much, you still have a lot of work to do to catch up as far as a general income to inflation increase. So how much your raise is, let's say inflation was 10%, right? And your raise was 5%. All right. Now they're saying, well, instead of inflation being 10%, it's 2%, right? But even if your income still got raised another 5%, you're still behind, right? You're still not up to where it needs to be, right? Over the last 2 years, it's been up 12%. It's not exactly how percentages work, but as far as adding them together, and your raise is still only up 10%, right? And most people aren't getting 5% raises every single year. All right, so these are the things that you need to understand when you're seeing these rates, and they're talking about interest rates, inflation, all these different type of terms and the terminology that's being thrown out there. This doesn't mean that your income is increased at all or will increase. Hell, they said the reason they did this was due to the softening job market. I mean, damn, how much more do y'all want them to say? Federal funds target rate, July 2000, September 2024. So we got 6% here, beginning, so July 2000, and right now 4.75 to 5%. So short, we're about at the 1% delta, but again, you can see this is a bad chart. This is a very bad chart. In short, coming out of the dot-com, bubble, 6% down into 1% in the 2004 range, early 2000, first quarter, in this early second quarter of 2004, then it shoots up in 2006. Then we have 2007 crashing all the way down. And look how low look how low the rates were that the Fed had pretty much during / after the financial crisis, all the way up until about a little after 2015, 2016. It was under really 0.5% the whole time. Then we slowly got a rise. Right, then the pandemic happens. You see a drop back down essentially to the same levels, and then we see this is the thing too. In short, this is what I'm talking about. What I'm saying, they're saying inflation, isn't as much, but see, we had this big spike from 2022 into 2023. So in short, that year, and that's the part that you got to keep up with. That's what your income needs to do as well. All right, so this big increase, that's bad for you in general. All right, and your income didn't match the steepness of this graph, so you need your income to match it. All right, and again, just because in short you see it going down, that you still have to accept that in the way inflation works, there's still this increase that's been occurring this entire time. I'm using my hand to point at the screen as if y'all can freaking see it, but I'm using my mouse as well so you can sort of see this graph. And for the podcast listeners without any visual. All right, I've got a note here. December 2008 to present, the chart reflects the midpoint of the Federal Reserve's target range. Target range beginning. Okay, I guess they have target ranges that they want to hit. Anyways. The decision to ease came in light of progress on inflation and the balance of risk. Notably, the FOMC vote was 11-1, with Governor Michelle Bowman Governor Michelle Bowman preferring a quarter-point move. Bowman's dissent was the first by a Fed governor since 2005, though a number of regional presidents have cast no votes during the period. We're trying to achieve a situation where they're trying to restore price stability. They're trying to help with inflation. And again, they're trying to help with, they're saying inflation is becoming more stable. However, unemployment is increasing. Inflation, unemployment, and how much people are making, those are three different metrics. All right, three completely different things. Even if, imagine say unemployment was high, but people's income was still roughly in the range that they wanted to be with inflation or DTI or whatever number we want to use. It's like, okay, you just need to get a job. The situation a lot of people are saying that now, even if they get a job, and sure, they need multiple jobs. One job is still not enough with the inflation damage that has occurred over the last 1 to 2 years coming, as we've been transitioning out of the pandemic. That's the number or the data that they're not talking about right here. Yes, unemployment is a pain right now, and it seems like inflation is tampering, even though it doesn't matter because we had such a spike in such a short period of time. That's why we're so in short, people aren't going to, even with the rates dropping, there's going to be people like me who've been, I would say, we haven't been waiting for the rates to drop, but it's like, okay, it's high they've been. It's like, I just keep saving. I'm not in a rush to get a house, so, but hey, if they're doing the drop, what you're doing now, it's like, okay, now you got to compete with me in the market. Right now, it's like, oh, now, it's like, stuff is becoming even more affordable. We're getting closer to them panorama numbers, but with, been saving more, things of that nature, increasing income, for people who aren't in the same situation as me. If you're trying to get out here and, let's say, when I say compete with me, but compete with people in a position where they've been holding off, but they've been making the right financial decisions as far as doing what they can to increase their income and continue to increase how much they can save. So in short, putting them in a better position to get a house when the rates do come down. I mean, it's going to be hard to compete with those type of people. And it's still competitive. Houses here in Maryland, they don't even be on the market for a month before they have, sometimes not even 2 weeks before you see it pending. So, and that's when you see it pending, on Zillow or whatever. Who knows when that's when they update it, right? All right, so what they're trying to do, right, again, help with the with the tampering of inflation and unemployment. That came with the inflation, right? All right, and that's from Chairman Jerome Powell. All right, trading was volatile. You have to talk about the stock market. Yeah, after the decision, Dow went up 35 points, but I believe the market ended up going down because they're still considered what it suggests about the state of the economy. Stocks ended, they lower. All right, Treasury yields bounce higher. This is not the beginning of a series of 50 basis point cuts. The market was thinking to itself, if you go 50, another 50 has a high likelihood. But I think Chairman Powell, really dashed that idea to some extent, said Tom Proselli, chief U.S. economist at PGM Fixed Income. This is a lot of words here. It's not that he thinks that's not going to happen. It's that he's not pre-committing to that to happen. That is the right call. Yeah, I mean, look, you don't want to predict the future on y'all, then y'all get upset. You see how President Biden did, right? You get the student loans about here, and the student loans are still sitting here looking y'all dead in the damn face. Our committee noted that job gains have slowed and the unemployment rate has moved up. And remember, when we talk about jobs, we don't care about not just the unemployment rate, right? What about the income attached to these jobs? Okay, notice that they didn't talk about how much money these people are making. All right, the FOMC officials raised their expected unemployment rate this year to 4.4. 4.4 is still not crazy from the projection of 4%, but still going up, which they predicted in June, and lower the inflation outlook from 2.3 to 2.3 from 2.6. Not a big, more delta still on the unemployment side by 0.1. On core inflation, the committee took down its projection to 2.6. Yeah, a 0.2% percentage reduction. Okay, June. Okay, in long run, neutral rate to be around 2.9%, a level that has drifted higher as the Fed has struggled to get inflation down to 2%, right? They're still struggling to get it down to 2%. And again, they want the inflation rate to be in the 2 to 4% range. Okay, and I know they're like 2%, so if it's 3%, 2 to 4% range. All right, 2 to 4% range. That's why they're saying about mortgages. Mortgage rates really in the 5 to 7% range. When they get above 7, it's like, all right now. When they get below 5, it's like, all right now. All right. Gross domestic product has been rising steadily. All right. Atlanta Fed, like 3% tracking for the third quarter. All right. Fed chose a cut, even though most gauges indicate inflation well ahead of the central 2% target. So they're saying, even though inflation is coming down, they're making a statement that the Fed still chose to cut rates, even though the projected inflation is not at where they want it to be at. Now that it's still not going down, but it's still not at the 2% projection. The Fed's preferred measure shows inflation, about 2.5%. Well below its peak, but still higher than policy that they would like it to be. However, Powell and other policymakers in recent days expressed concern about the labor market, while layoffs finally to the labor market, which is the reason they did these rate cuts in the first place. Layoffs have shown little sign of rebounding. Hiring has slowed significantly. In fact, the last time the monthly hiring rate was this low, 3.5%, as a share of the labor force, the unemployment rate was above 6%. Right now, they're saying unemployment, they're projecting to be around 4.4%. So still got a ways to go. But again, you could, when I say depending on how this election goes, just in general, right? We're across either side that wins, we can see a turn, a significant turn in the market. And Cory, at his news conference, Chairman Powell, remarked that 50 basis point cut was not something they're not thinking about right now. They just did it. Look at this. For the moment, at least, the move helped settle a contentious debate over how forceful the Fed should have been with the initial move. So I feel like basically this article, it was 11-1 vote, but they're trying to make it clear that this could be a one-time thing. But when you just run out the math, you got to do it. If you want to get down to 2% by 2026, let's say it's the end of 2026, you got to do but so many cuts relative to the raises you're going to do. It's not like they usually don't cut stuff by, a point, by 1 basis point type of thing, or 0.1 basis point. All right, increases to the U.S. Federal Reserve's rate since 2022. All right, so we're just looking at more of a table. So that we had no cuts or increases this year, in short, until this month, September, with a 50 basis point cut. In 2023, we had increases. I wish this they got this in descending order for whatever reason. All right, 2023, we had four increases, 25 basis points. And in 2022, my God, we got 250s, 475s, and a 25 increase. However, it says to say, in short, this would be a good example to show you, like, even though they're saying that, hey, we want things to be better as far as people being able to get jobs. So they're looking at unemployment. But what about when people do get employed, that unemployment number goes down? How does that income compare to what inflation has done? So in short, you're seeing in 2022, we got all, imagine this is inflation, not these numbers, but just the concept of inflation is going up and up and up, up and up. Okay, but still going up. All right. And then we finally have this, right? This cut of 50 years. So let's say we just did this math here. I mean, it's, what is that? 150, 300, 400, 500, right? I think it's 525. So we're up, right? Over 450 in short. And if your raise has only been 200, right, in this time period, 2022, 2024, you can see how far behind you are. That's the part that this article is not addressing, and what you see a lot of Americans complain about when they say they can't afford things. So even though you hear that inflation is getting closer to that 2% range, where they rarely tell you, I say rarely, at the same time, to have a full conversation about the economy, unemployment, the job market, things like that. Because remember, the job market is why they're saying they really did these cuts as far as unemployment rate, thinking that it's going to be a little bit higher than they want it to be. Even if you're employed, if you don't got the money, if you don't have the money that you want to have, I got to go to another job. And again, that's what people are complaining about, really. Hey, I got to have 2 jobs, 3 jobs. But I mean, dual income households, 2 jobs. I recommend y'all make as much money as you have. All right, however, it sets the stage for future questions over how far the central bank should go before it stops cutting. There was a wide dispersion among members for where they see rates heading in the future. Investors' conviction on the move vacillated. Let's say, what is that? Vacillated in the days leading. I'm going to look it up. I'm not sure I pronounced that right. Anyway, in the days leading up to the meeting, over the past week, the odds had shifted to a half-point cut with a probability of 50 basis point at 62%. Okay, they're just talking about the chances of it. Okay, Fed in 2020 pandemic response, because they did the cuts. We understand that they're talking about the 75-point basis cuts. The current jobless level is 4.2%, drifting higher over the past year, which I would assume it's a bad thing. Sorry, y'all. All right. This was an atypical big cut. Porcelli said, "We're not knocking on recession's door." Yeah, they did. Technically, we were in a recession. We had those 2 quarters back to back, a decrease, but they still didn't say it was a recession. This is easing. And this bit cut is about recalibrating. I should say big. Yeah, B and T, G and T are next to each other. It's about recalibrating policy for the fact that inflation has slowed down so much. All right, with the Fed at the center, okay, global finance universe, Wednesday's decision will likely reverberate among other central banks. Factors drove global inflation higher. They crippled in it. Yeah, talking about the panorama, I believe. Yeah, and what that did to the global economy. Bank of England, European Central Bank, and Canada's Central Bank all have cut rates recently. The others awaited the Fed's cue. Last sentence here. As we wrap up, while the Fed approved the rate cut, it left in place a program in which it's slowly reducing the size of its bond holdings. The process, nicknamed quantitative tightening versus quantitative easing, quantitative tightening has brought the Fed's balance sheet down to 7.2 trillion. No, it's only down to 7.2 trillion, a reduction of 1.7 trillion. Trillion is such an insanely large number. Borderline, not even comprehensible. Most people how big 1 trillion is, let alone 7.2. The Fed is allowing up to 50 billion a month in maturing treasuries and mortgage-backed securities to roll off each month, down from the initial 95 billion when quantitative tightening started. All right, that's it, y'all. I can top this article. End of the episode. Fed slashes interest rates by 0.5 point, an aggressive start to its first easing campaign in 4 years. And forgive me, y'all, I normally read this person's name, but we got an easy name this time. Shout out to Jeff Cox for this article. All right, that's it, y'all. Locked and loaded. End of the episode again here. Necessities, debt payments, investments, lifestyle. If you're in a situation where you were waiting for rate cuts to occur for you to get out here in the housing market, and because like you literally, let's say the most you can afford is a $300,000 home, it's not gonna be more. I'm gonna say 500,000. I'll get to the Maryland number, 600, 700, right? Let's say it's $300,000, and the reason you can't afford that home or haven't been in the housing market is because interest rates were too high. Now you might need to lower how much money you were looking on spending on a house. And that might mean you have to move, either move or increase your income to compensate, whichever one you want to do. But a lot of times it wasn't that the interest rate is the reason you couldn't get your house. You just had, your eyes, you're trying to eat more than you can handle, in short. And even though we had the pandemic numbers at 2% and 3% ranges, there's a reason it only happened. It was historic and it was just there for when it was there. When we're in that, like I said, that 5 to 7% range, that is more what you need to expect and really need to be having in your budget when you're seeing things. When we get above 5%, we start getting to that 10% range, even though people, baby boomers and younger, they were buying houses when, we had interest rates above 10% for mortgages. That's when it's egregiously high. That's when there's a significant problem. But when that 5 to 7% range, it's like, okay. And now we're talking about looking like stuff might get below 5%. It's like, I think Monday. Yeah, Monday, I was told 5.5%. And I believe that following day, that Tuesday, I was told 5.4. So, and that was before these cuts. These cuts happened Wednesday. Today's Thursday. So we might be seeing things getting below 5%, getting down to that 4% range. If they're talking about doing these cuts, they're really going to put stuff back to what was in the panorama level. See, they're talking about doing this stuff. Remember, the pandemic era cuts, as I wrap up, were in short instantaneous. The way they brought them down, right? We just had them rates down like that. If we see this again, then you would think they're not going to lower rates again and create the same type of inflation problem, even though we shouldn't have another pandemic, but have the increase as far as money pumped into the economy as what happened with the panorama. We should see, in theory, as they're doing these rate cuts, the goal is to have, more stabilization when it comes to the economy, right? That's what we want. But that's it, y'all. Again, make sure y'all comment, like, share, and subscribe. Shout out to the YouTube algorithm. Make sure you leave those rating reviews on the podcast platforms as well. My information, as well as my coach Jordan information, can be found in the description. I am _Cory for your financial information, and Jordan is Stop Stalling J for your fitness information, and FinallyFit.live where we can go to sign up for the 5:30 a.m. Eastern Standard Time virtual training sessions with Jordan. All right, and again, y'all, I have not forgot about the taking out of context. I know. I've been recording almost a month, like I said. Got some stuff going on here. But we getting back situated. Work ran crazy at training day. There's a lot of movement stuff, but we still got enough content that we're at least going to keep dropping the clips for y'all. But the plan is to get more content out, so the clips are coming out faster and then more relevant. That's good for us, so we can stay more in the algorithm. What's actually popping in the algorithm, and so you guys are getting more information and more stuff for those people who don't like watching the full clips. All right, but again, y'all, got any questions, comments, concerns, please reach out to us or leave a comment. All right, remember to save more, say less, keep making better your best, and I'll catch y'all in the next one.